Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The challenge for the Reserve Bank got a bit trickier yesterday with monthly inflation climbing for a second month in a row. Economists had expected it to drop from 3.5%, that's an annual rate, to 3.4% for the year to April. Instead, it rose to 3.6%. Add in data earlier this week that showed retail sales per capita are at their lowest level in 2 years. And it's quite the balancing act for the Reserve Bank, getting stubbornly high inflation back into the target range when consumers and businesses are already hurting. Cherelle Murphy is the Chief Economist at EY. Cherelle, welcome back to Fear and Greed.
Thank you, Sean. It's lovely to be here.
Let's start with yesterday's numbers. Were you surprised that it came in where it did, and why did it come in where it did?
Well, it was a little stronger than expected by the market, but we've been warning, as you know, that for some time that we're a little concerned about the inflationary pressure being on the upside. But look, there's a lot in there. So this is the April number, so it's one of the monthly numbers. It is not a comprehensive picture of the CPI. There's about 40% of it which is kind of held unchanged, so they're only measuring, effectively 60%. I guess, though, the components that went up a lot didn't surprise us. So essentials like housing, food and transport, these were where there was a lot of upward pressure. We know in April that, of course, the health insurance premiums go up. So that was in there too. That pushed up health costs. There was a lot that we did expect. But I think probably more concerning was that increase in the trimmed mean that rose up from 4% in the year to March to 4.1%. That is the measure that grabs the core of inflation. As I say, though, this is a monthly number, so we do have to be a little bit careful about how we read that.
Okay, so where do we stand on inflation then? We have a Reserve Bank meeting next month, I think. But where do we stand on inflation after yesterday's number? Is the trajectory still going in the right direction, or have we sort of flattened out?
Yeah, I think at best it's flattened out and potentially it's gotten a little worse. So we can see that, as I was mentioning, those core measures of inflation are not coming down as fast as the headline measures. And in fact, in some of the recent indicators, that slight tick up. Now, that may be nothing, and it's probably a bit early to tell whether that tick up is significant and we'll hold on to it. But you'd have to say that it's not really going the Reserve Bank's way at the moment. It's just at the margin going the wrong way. Now, they, of course, expect inflation to come back into the target band by the end of 2025, and they've got a fairly low tolerance for things going wrong. And so I do feel like this might concern them a little bit, yeah.
Okay. Didn't we have something similar at the Fed in the US a few months ago where things actually just looked like they were going a little bit the wrong way at the margins, but then the next number came in and it seems to have self-corrected almost?
That's right. And that's why, we've got to be really careful about kind of extrapolating one number into a future trend, because we really don't know. But on the basis that we've still got a strong labour market, the housing market, as you know, is throwing up pretty bad numbers in terms of inflation. There's a lot of activity happening in the housing market. Now, of course, the price of houses is not in the CPI, but I think it is representative of an economy to some extent that's, running quite strong and where demand pressure is quite high. And then you put that together with some of the international forces that might be pushing a little bit of upward pressure on prices. Petrol prices, as we know, are incredibly volatile. And then we've got the impact of all the cost of living measures, which are going to flow into the numbers over the next little while. And I do think we should continue to be concerned about inflation.
Stay with me, Cherelle. We'll be back in a minute. My guest this morning is EY Chief Economist Cherelle Murphy. So let's bring the consumer into this discussion. We saw the retail sales figures earlier in the week. Sales are up, I think it was 1.3% for the year to the end of the month. I think consumers are struggling out there. At what point does the Reserve Bank say, okay, we know that to help consumers long term, we need to get inflation into the target range, and Michelle Bullock has made that very clear. But that's kind of like a medium-term answer here. We've got some real short-term problems, people literally living in cars because they can't afford housing. How does a Reserve Bank balance that?
It's really hard. Essentially, it can't. It can't do anything about it. It's really up to both the Commonwealth and the state governments to manage this and to help get through this difficult period. And of course, that's what the cost of living measures that have been delivered in the federal budget in the form of the energy bill relief and, some of those other little measures that they had in there, try to reduce HECS debt or give small payments to those students on pracs. These are the kind of measures that they're trying to use to help people through without creating too much inflation along the way. But what can the Reserve Bank do about it? Really nothing. It's just got to kind of grind away, make sure that we all continue to believe that inflation will get to 2.5% and it will roughly stay there over the long term. And that's the best thing they can do to manage the way people behave to minimise inflationary risk.
Far be it for me to tell a former Reserve Bank economist, now Chief Economist at EY, what to think. However, Cherelle, I have a solution for Michelle Bullock and friends. Is it not possible for them to actually cut rates slower? So, spend 2 years cutting rates and do it very slowly so that any relief will be welcome. It may mean that it takes a while longer for inflation to get back into that target range, but at least there is some relief, as opposed to the trajectory now where the potential for putting the consumer into a tailspin is real and suddenly you have to cut rates quickly. So kind of having a halfway point, or is that just wishful thinking?
Well, I think the sort of cautious approach is probably welcome, but the reality of the inflation problem is that the longer that inflation stays outside the 2 to 3% band, the harder it is for the Reserve Bank to control it. So, as I said, people's behavior would start to change to expect higher inflation. So businesses, for example, might put their prices up 3% instead of 2%. Workers, when they are negotiating wages, would say, well, to keep up with the cost of living, I need a 4% pay rise instead of a 2% pay rise. And that therefore begets more inflation. So for the RBA, at least until they're at the point where inflation is back in the band, they've really got to be very, very focused because that credibility is everything to them.
The dismal scientists. Tell me, interest rates then. It doesn't look like, from listening to you then, it doesn't look like the Reserve Bank's going to do anything too much too soon.
I don't think so. And I've kind of thought that really since the end of last year, that it's just too soon for the Reserve Bank to risk letting go of its inflation ambitions here. There's just too many risks that things would get away from it. So the policy of least regret, which I think is always a good way to think about central banking, is to just hang on to rates where they are for a while. Obviously, if we do get some upside surprises on inflation, they can then go up, actually take the cash rate up. But equally, if they go too soon on the downside and inflation races away again, it's going to be much harder to pull down a second time around if they make a mistake.
So the next big data point, I mean, everything's big data point, but the June quarter inflation isn't out to the end of July. Am I right in that?
Yeah, that's right. It's a long time away.
But do you think the Reserve Bank would move in any direction ahead of the quarterly number?
I don't think so. I don't think that there's enough of a signal either way, to be honest, to move before then. No, unless there was, some incredible shock. But even then, it would probably be a short-term factor, which they would be unlikely to respond to unless it was, something as big as COVID or the GFC. It's likely that they're going to sit pat, I think, and just continue to watch that data for a little while yet.
Cherelle, thank you for talking to Fear and Greed.
My pleasure, Sean.
That was EY Chief Economist Cherelle Murphy. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.